Hey fellow investors, welcome back to the channel. Today's video is about the ever-popular Seatrium, and I'm approaching it from a slightly personal angle. I do own some Seatrium shares, but not because I went out to buy them. They came to me through the corporate actions for my holdings in Keppel Corp and Sembcorp, so it started as a position I inherited rather than one I initiated, and I suspect I'm not the only one in this situation. There are investors who hold Seatrium today because it ended up in their portfolio as part of those corporate actions, and they're now asking a practical question: what exactly am I holding, and does it still make sense to keep it? At the same time, there are also investors who are actively following Seatrium as a recovery story, trying to judge whether the company is becoming more consistent and investable over time. So this video is meant to be useful for both groups of investors. I want to step back and assess Seatrium on its own merits today, not based on old narratives, not based on headlines, but based on what the company is doing now. What trends look genuinely positive, what risks still deserve respect, and whether the business is becoming more predictable. And at the end of this review, I'll have a clearer view on what I personally want to do with the position, whether I'm simply comfortable continuing to hold it as is, or whether Seatrium has progressed to the point where I would consider building it into a more intentional position in my portfolio, if the fundamentals justify it. As always, just a reminder that this video is for informational purposes only and not financial advice. Always do your own research and consult a licensed advisor before making any investment decisions. I own some of the shares discussed, but remember, what works for me might not work for you. Alright, let's dive in. What Seatrium actually is, and why the market still treats it differently. Seatrium is an offshore, marine and energy engineering group. In plain language, it builds and services large, complex assets for the global energy ecosystem, from offshore production systems to specialized vessels, and increasingly, infrastructure linked to energy transition themes. But the most important thing to understand is not the label, it's the business model. Seatrium is a project-based company, and project-based companies behave differently from the businesses that usually anchor an income portfolio. In a REIT, you can analyze occupancy, lease expiry, tenant strength, financing maturity, and cost of debt. In a bank, you can track net interest margins, credit costs, and capital buffers. Those businesses can still face stress, but the range of outcomes is often more bounded and the cash flow rhythm is more predictable. In a project business, outcomes are shaped by contract terms, milestone payments, variations, supply chain execution, claims and counterclaims, and how disputes are resolved. The end market can look healthy, and yet margins can still disappoint if a few large projects go wrong. On the flip side, execution discipline can turn a difficult industry into a profitable one. This is why the market has always demanded more proof from Seatrium than it demands from a steady compounder. The market isn't only pricing demand, it's pricing trust in execution. And once you see Seatrium through that lens, the right question changes. It's less about whether the cycle is supportive, and more about whether the company is becoming consistently reliable. Positive business trends: what looks better today than it did before? To be fair, there are meaningful improvements that deserve acknowledgement. This is not the same conversation investors were having a few years ago, when the focus was survival and balance sheet stress. Trend 1. A large, long-dated order book that provides multi-year visibility. As of end September 2025, Seatrium reported a net order book of 16.6 billion Singapore dollars, comprising 24 projects, with deliveries extending through 2031. That's a substantial backlog for any Singapore-listed industrial company. And what it tells you is not profits are guaranteed. It tells you that Seatrium continues to win and retain meaningful work, and that customers are still awarding large-ticket projects. There's another small detail in the 3Q update that I think is worth noting. The Business Times reported that new orders in that period were mostly from returning customers. In project businesses, returning customers matter. They don't eliminate risk, but they are often a sign that the customer experience, delivery capability, and commercial relationships are still strong enough for clients to come back. It suggests Seatrium's capabilities remain relevant, and that the company is not winning orders purely on desperate pricing. For a project business, the order book is a form of oxygen. Without it, you don't have runway. With it, management has the chance to plan capacity, sequence project execution, and build a steadier operational cadence. You can see how central this point is in broader market discussions too. which has shifted, less about whether Seatrium has work, and more about whether it can translate that work into dependable outcomes. Trend 2. Profitability has returned, and that shifts the baseline conversation. Seatrium reported FY 2024 net profit of 157 million Singapore dollars, and an underlying net profit of 200 million Singapore dollars, reversing from an underlying loss in FY 2023. The annual report also highlights a few supporting numbers that give context to that turnaround. For FY 2024, revenue was 9.2 billion Singapore dollars, EBITDA was 627 million Singapore dollars, and underlying EBITDA was 771 million Singapore dollars. I'm not quoting these to make the story sound bigger than it is. I'm quoting them because they give you a sense of scale and operating momentum. A turnaround that happens off a very small revenue base can sometimes be fragile. A turnaround that happens while revenue remains sizable suggests the company is executing across a meaningful book of work. The reason I pay attention to the return to profit is not because 1 year proves the turnaround. 1 year rarely proves anything in a project business. But profitability returning does change the baseline discussion. It reduces the immediate existential question, can the company survive and fund itself? And pushes the investor's focus toward, can the company sustain profitability through consistent execution? That's a healthier problem to analyze. Trend 3. Balance sheet and financial posture look more stable than the old crisis narrative. Turnarounds are not just about the income statement. They're also about whether the company can operate without constantly leaning on emergency measures. In Seatrium's FY 2024 annual report highlights, the company disclosed a net debt to EBITDA ratio of 1.1x and a return on equity of 2.5%. These are not numbers that tell you everything is safe, but they do suggest that the financial profile is not stuck in a perpetual distress state. For a company with a difficult history, that matters, because stability gives management the space to focus on execution rather than just survival. Trend 4. The work pipeline remains anchored in long-cycle energy infrastructure. One reason Seatrium continues to attract investor attention is that its end markets are typically long-cycle. Offshore production systems, complex vessels, and certain energy transition infrastructure projects tend to be planned years ahead and executed over multiple years. That matters because long-cycle demand gives a project company the opportunity to build repeatability. It gives management the runway to improve planning, reduce mistakes, refine contract selection, and gradually uplift margins across a portfolio. In other words, the business has the potential to become more predictable, but it can only do so if execution improves. The demand backdrop helps, but it doesn't replace discipline. Trend 5. The narrative has shifted from survival to delivery. When I read company updates and market commentary around Seatrium, I pay attention to the tone of what is being discussed. In Seatrium's 3Q 2025 business update, the company emphasized the size and duration of its order book, and the surrounding market commentary has increasingly centered on execution, deliveries, and converting backlog into earnings, rather than existential questions. I think it reflects that the story has progressed from a crisis narrative to an execution narrative. Before we go further, a quick note. If you find this kind of calm framework first breakdown useful, especially for Singapore stocks that may be showing indications of recovery, do hit the like button. It is the most direct way to help the channel reach more long-term investors. And if you prefer reading the analysis, I post the research-style write-ups on my website at thedividenduncle.com so you can pause, revisit, and digest the key points at your own pace. Now, back to Seatrium. Turning a recovery story into an investable story, what matters in a project business? This is the part that many investors rush through, and it's where mistakes happen. When a company returns to profitability and holds a large order book, it's tempting to jump straight to valuation and ask, is it cheap? But in a project business, the more important question is, how stable is the path from order book to earnings and cash flow? A large order book can coexist with poor returns if contracts are mispriced, if costs overrun, or if disputes delay payments. And the reverse can also be true. A smaller but higher quality book can sometimes produce better profitability. So to assess Seatrium's investability, I think in terms of 3 transformations the company needs to sustain over time. First is a transformation in project selection. Not all work is good work. The best project companies learn to walk away from contracts that carry asymmetric downside. Second is a transformation in execution repeatability. It's one thing to deliver a few projects well, it's another thing to deliver across a portfolio, with fewer surprises, as the normal state. Third is a transformation in cash conversion quality. In project companies, you can see reported profits while cash collection remains uneven, depending on milestone structures, claims, and settlement terms. Over time, the market rewards the company when profitability and cash flow begin to align more cleanly. The reason I'm emphasizing this is simple. Seatrium's market valuation will ultimately be driven not just by whether demand exists, but by whether the market believes the outcomes are becoming narrower and more predictable. That's what trust re-rating actually means. The risks that still matter, and why they keep the market cautious. Even with positive trends, the risk profile remains structurally wide, because a project business can still surprise you in ways that are hard to model from the outside. Risk 1. Disputes and arbitration are part of the operating reality, and they affect trust. In January 2026, there was public disclosure and media coverage around arbitration related to the Dole Wind 5 offshore converter platform project, involving Seatrium and consortium partner Able. Reports described Seatrium making claims of around €180 million and facing counterclaims of around €130 million. I'm not going to speculate on arbitration outcomes. As outside investors, we simply don't have enough information, and legal proceedings can be unpredictable. But what we can do is understand how the market interprets this. For a company still rebuilding credibility, disputes matter because they introduce uncertainty about timing of cash collection, allocation of responsibilities, and potential margin outcomes. Even if the financial impact is ultimately contained, the existence of such disputes keeps the market's range of outcomes wide. And when the range of outcomes is wide, valuation multiples stay conservative. That's why Seatrium can show improving profitability and still not be rewarded smoothly. The market is not only looking at the numbers, it is asking whether unpleasant surprises will keep returning. Risk 2. Resolve doesn't always mean simple. The Maersk settlement is a good illustration. Another major headline was the dispute with Maersk over an offshore wind vessel contract. Reuters reported that Seatrium and Maersk reached a settlement where Maersk would pay the remaining $360 million of the contract balance, with about $250 million structured via a 10-year interest-bearing credit arrangement, to be repaid through cash generated by the vessel's operations. Directionally, a settlement can be better than prolonged litigation. It reduces uncertainty and avoids the risk of a drawn-out legal battle. But it also reminds investors of a key feature of project businesses. Even when problems are resolved, the resolution can come in structured forms that affect timing, cash conversion, and overall certainty over a longer term. Hence, for long-term investors, it's not enough to ask, did the company win or lose the dispute? The deeper question is whether earnings and cash flow become cleaner and more predictable over time. Risk 3. Cash conversion and working capital can be less visible from the outside. Project businesses can report profits while still having uneven cash flow depending on milestone schedules, claims, and payment structures. This is not unique to Seatrium. It's the nature of the industry. But it matters because investors who are used to REIT distributions or bank dividends can underestimate how much timing can influence reported performance. When you see a profit number, you also want to understand the mechanics underneath it. Is it coming from clean project deliveries and collections, or is it influenced by claims, settlements, and timing effects that may not repeat? I'm not suggesting anything specific here. I'm simply explaining why project companies often trade at a discount. The market wants a higher margin of safety because it cannot easily see the cash flow plumbing from the outside. Risk 4. Headlines can dominate short-term price action, and that creates psychological risk. Even if the business is improving, a stock like Seatrium can move sharply on a single update, especially if that update touches on disputes, delays, or large project milestones. This creates a different kind of risk. Psychological risk. If a position is sized too large, short-term volatility can pressure investors into making decisions that are not aligned with their original time horizon. That's why Seatrium shares tends to punish investors who treat it like a calm, income stock. The stock behaves more like a company still rebuilding credibility, where the market continuously adjusts its confidence level based on new information. Risk 5. Legacy perception takes time to unwind. Finally, There's a very real market memory component. Even if the company is improving, the market does not reset trust overnight. Investors who live through earlier cycles will demand multiple periods of clean execution before they treat Seatrium as a normal industrial business. This is why Seatrium's recovery, if it continues, is unlikely to be a straight line. The market will likely reward proof, then pull back on uncertainty, then reward proof again. That's how trust is rebuilt. And if you're not prepared for that kind of journey, this stock can be psychologically expensive even if the long-term fundamentals improve. The dividend uncle's take, where Seatrium fits, and where it doesn't. Now we come to the question that sums it all up for me. Would the dividend uncle buy Seatrium at this point? Here's how I would frame it. Seatrium is not a natural core holding for the way I build a long-term income-oriented portfolio. A core holding, in my definition, is something you can justify owning through most environments because the business model is resilient and the range of outcomes is relatively bounded. Seatrium, by nature, has a wider range of outcomes. That doesn't make it a bad company, and it doesn't make it uninvestable. It just means it belongs, if at all, in a different bucket. If I were to buy Seatrium, it would be as a satellite exposure, sized to reflect uncertainty, and perhaps with a potentially shorter holding period. The story that matters to me is not whether the order book is large. It's whether Seatrium can build a multi-period track record where delivery becomes more repeatable, disputes become less headline-driving, and cash conversion becomes more stable over time. If that happens, then the market discount can narrow. To me, Seatrium has not reached the point of sufficiently comfortable, predictable outcomes. So until that pattern is clearer, I personally would not be going in big on Seatrium. For investors willing or more comfortable with taking a bigger risk, it may provide an attractive returns. So I may miss out on some good returns, but for now, I accept the humility that this is not the path I've chosen for Seatrium. Let me close with a balanced summary that fits the dividend uncle mindset. Seatrium has clear positive trends. The 16.6 billion Singapore dollars net order book, extending to 2031, shows multi-year visibility and continued customer engagement. The return to profitability in FY 2024, including 157 million Singapore dollars net profit and 200 million Singapore dollars underlying net profit, is a meaningful milestone in the normalization story. At the same time, Seatrium remains a project business with a wide range of outcomes resulting in uncertainties for stock valuations. The DolWin 5 arbitration headlines and the structured nature of the Maersk settlement remind us that disputes, contract complexity, and cash conversion uncertainty can still surface, and they directly influence market certainty. So if you ask me whether Seatrium is good or bad, I think that's the wrong framing. The more useful framing is, what is the business trend? What are the risks? And does this fit your portfolio objectives? For me, Seatrium is not a holding I'll buy more. But if you've been tracking Seatrium, let me know in the comments what you're watching most closely, not what you hope happens, but what evidence would convince you that the story is truly becoming more predictable. Alright, until next time, happy investing!